Hello, I'm Gunnar DeLay with Cambridge Wealth Management. Welcome to another installment of Common Sense, where we give practical advice on tax planning, retirement, and estate planning. Today I want to talk about one of the most important decisions a new business entity can make, and that is, what will our business structure be? Will it be a sole proprietorship, a general partnership, a corporation, or an LLC, which is a limited liability company? When making that decision, most people ask, well, what's the big difference between an LLC and a corporation? Let me explain. Corporation, you have to have annual election of officers and board of directors, and you have to keep minutes of those elections, and you have to keep minutes of every business decision that's made. Most people don't do that, and if you fail to do that, you actually expose yourself to the possibility of having that corporate entity set aside, which could be very problematic if you ever find yourself on the other end of a lawsuit. A limited liability company allows you to have that same protection under the law, which shields you from individual liability in the event that you're sued, but it doesn't have all the requirements for the cumbersome paperwork. There's no elections, there's no minutes, things of that nature. So for that reason, it's very attractive. But I want to make one other recommendation, and that is that you consider making an S-corp election. An S-corp election can be made either for a corporate structure, but it also can be made for an LLC structure. And what that means is that, let's say you're making $100,000. If you haven't made that election, that at the end of the year, you are going to pay state, federal taxes, income taxes, and Medicare and Social Security on that full $100,000. But if you've made the S-corp election, then you can set a salary at $50,000, pay those taxes on that $50,000, but on the other $50,000, you can take that as a distribution. You don't have to pay Medicare and Social Security on that distribution. That will save you roughly 15% in taxes. That's a nice savings. So it's a consideration most people don't know about unless they've talked to a financial professional. In addition, if there are multi-members in your entity, 2, 3, 4 people, you want to consider putting together a buy-sell agreement, which basically sets forth the terms of what happens in the event one of your partners, co-owners, passes away, retires, becomes disabled. And you probably want to do that in conjunction with an attorney that knows what he's doing. If we can ever help you with any of these things, check us out on the web at www.cambridgefg.com or call us at 479-783-0467. Thank you and have a good day.